Good afternoon. Thank you for joining us for today's Capital Management Corporation's March webinar. This is Scott Davila. I'm Vice President of Client Relations and Marketing here. And joining me today are Tim Call, President and Chief Operating Officer, and Mark Livesay, Vice President and Portfolio Manager. Before I jump into the agenda, I wanted to remind everyone that we will have a Q&A at the end of the presentation. You should have a toolbar up on your screen, and you'll see down below caret, and next to the caret you'll see the word questions. You can click on the caret, you'll get a drop-down menu, and you can type your question in there and press enter, and we'll receive it. We'll try to get to all the questions that we get today. If we do not, we will respond individually to everyone. And the second thing is that we are recording. We will put this up on the website either tomorrow or first thing Thursday morning. So if you want to go back and listen to it, or you couldn't join us for the entire presentation today, it will be up on our website. So for today's webinar, Mark is going to talk about key factors that likely will have an impact on the market this year. Tim will jump in and discuss how the market has been shifting away from a concentrated mega cap tech stocks towards broader market participation. And then Tim will also discuss and highlight several of our firm's holdings. And with that, I'm going to turn it over to Mark.
Thank you, Scott. This slide lists some recognized areas of uncertainty for the market this year. Geopolitical stress is a constant in the world. I think we all feel that acutely today. Earlier this year, Venezuela was in the news with the United States capturing its dictator. Currently, the U.S. is engaged in military actions in Iran. Instability in the Middle East is nothing new, but the acute nature of today's conflict has led to a spike in oil prices. Tariffs provide another area of uncertainty following Liberation Day nearly a year ago, and the Supreme Court's ruling on the legality of certain tariffs last month. The 178-page Supreme Court ruling does not make all tariffs illegal, but it does limit the scope of certain tariffs from the executive branch of government. We expect tariff issues could be back in the courts over the coming months and potentially years. United States debt and deficits could make future bond sales by the government more expensive with higher interest rates. Government shutdowns seem to be more and more common. Last fall, the government was shut down for a month and a half, and we are currently in a partial government shutdown today. Midterm elections in November will garner a lot of media attention and spending on both sides of the aisle. As we have mentioned on prior calls, uncertainty is always a factor in the market. Given the timing of this call, we wanted to spend a little more time on how world events have impacted the stock market in the past. This showed the S&P 500 on a log scale since the late 1980s. There's been no shortage of upheaval for the globe in this period, including the fall of the Soviet Union, 9/11, a global financial crisis, and global pandemic. Through it all, patient, long-term investors have been rewarded. More recently, if you were at a New Year's Eve party in December of 2019, and someone had a crystal ball that accurately predicted the upcoming COVID pandemic, followed by 40-year highs of inflation, a ground war in Europe, continued violence in the Middle East, and record tariff announcements in the United States, you may have been inclined to avoid stocks. However, the ensuing stock market return was well over 100%. With the current conflict in Iran, the most obvious economic impact is potential disruption to energy markets. Previous sanctions have lessened the impact of Iranian oil to most markets. It is estimated that 3 or 4% of the world's oil is supplied by Iran, with 80% of those exports going to China. The Strait of Hormuz off the Iranian coast is an important passage for global oil production traveling out of the Persian Gulf. 20% of the world's oil passes through this strait, so disruptions on this waterway could have larger impacts on oil supplies. It is difficult today to predict with any accuracy how the next few days, weeks, or months will play out with this conflict. But market history teaches us that the best course of action is patience and not panic. Next, many of you will be familiar with this chart. Going back to 1980, it shows the price return of the S&P 500 in the gray bars. The market has had a positive return more than 3/4 of the time. The red dots indicate the largest pullback in the market for each 12-month period. As you can see, equity market pullbacks are common. Most years have a pullback of at least 8%. The average pullback in any one year is 14.2%, with a median pullback of 10.5%. Every 3 to 5 years, you typically get larger pullbacks, close to 20%, which would indicate a bear market. In times of volatility, it is important to stick to investment disciplines. Price declines can offer good buying opportunities as long as emotions do not lead to panic. Despite geopolitics, we believe that 2026 will achieve strong economic growth, moderating inflation, with moderate job growth. How can you have all those things at the same time? Productivity. Increased productivity is simply getting more output per unit of input. Technological advancement can often lead to increases in productivity as workers become more effective using new tools. During the post-World War II era, productivity in the United States has averaged 2% per year. However, the most recent reported period showed a near 5% increase in productivity. We believe productivity can continue to run well above average for 2026 as companies have adjusted to the post-COVID economy, rapid technological changes continue, and the burden of red tape is reduced for businesses. Increases in productivity should lead to greater corporate profits, a positive for CMC Holdings. Productivity should not be the only tailwind for the economy this year. We are expecting a healthy tax refund season this spring. Increased deductions from raising the cap on state and local deductions, also known as the SALT cap, higher deductions for seniors, and higher deductions for tips could all lead to record tax returns. Early IRS data shows tax returns are 10.2% higher than this time a year ago. Consumers can spend the return or pay off debts with this newfound money. The consumer is 2/3 of the U.S. economy, so a healthy consumer is an important tailwind. Businesses also face a more tax-friendly environment with accelerated depreciation. Inflation is likely to continue to moderate. Shelter represents about 1/3 of the CPI index. We've talked about this a lot in this forum before. Home price appreciation has slowed from the post-COVID boom, and rents in many areas are actually coming down. Reshoring and foreign investment in the U.S. are expected to accelerate this year. Many countries and industries announced plans to invest heavily in the United States last year during trade negotiations. Banks are increasing lending activity, and lower interest rates make debt more attractive. The banking industry has healthy balance sheets and faces less stringent capital requirements, facilitating increased lending. Bank lending tends to be safer than certain private credit markets. Banks adhere to strict underwriting standards and may not be involved in some risky areas of excess, like some private credit funds. Banks unleashing more credit is generally positive for economic growth. Now I'll pass the call to Tim to discuss some recent trends in the market, as well as some of our CMC holdings.
Thank you, Mark. We are seeing a market leadership change. Small U.S. firms tend to be more domestic focused than much larger firms. As Mark outlined, many economic trends have changed in the U.S., including declining overnight interest rates, lower taxes, larger refunds, less regulation, moderating inflation, rising productivity, reshoring, and major increases in capital spending. These changes increase domestic economic growth. They serve as catalysts for a broadening of the market. Larger firms, on average, are harmed by more tariffs and a weak US dollar. This chart shows that a shift in relative performance has taken place. In recent years, the largest stocks logged stronger gains. For example, last year, the S&P 500 Large Cap Index more than doubled the results of the S&P 400 Mid Cap Index and the S&P 600 Small Cap Index. In just the first 2 months of this year, those mid and small cap indices are already up 8%, while the S&P 500 has risen less than 1%. Historically, the largest stocks tend to receive low valuation multiples. They just don't have as much room to grow as smaller firms. In the 1980s, Apple and Microsoft were small caps, and they had a lot of room to grow. On a forward basis, these behemoths are unlikely to repeat that exponential growth. Today, valuation metrics appear upside down compared to their traditional levels. Looking at the middle column, by historical standards, the largest firms appear greatly overvalued, and many smaller firms appear undervalued. The last column shows median size of the 10 largest firms, then the S&P 500 index, and then our client portfolio models. The median size of the 10 largest market capitalization stocks is almost $2 trillion for one stock, one company. A firm that is only 1% of that size would be a mere $19.5 billion in market cap. Can you remember when $19.5 billion was a large amount of money? Some still consider $19.5 billion firms to be quite large. Yet the median of the top 10 stocks is 100 times larger. This infers the largest market cap stocks are a bit ahead of their skis. Avid skiers know not to get ahead of their skis, as subsequent moves are perilous. Our average holding is at the other end of the spectrum. The median size holding in our dividend-focused portfolios is less than $10 billion, and our small and mid-cap portfolio sports a median market capitalization of less than $2 billion. Our portfolios can invest in these so-called smaller firms. A $100 billion mutual fund cannot. Active mutual funds face legal and regulatory limits, including 10% ownership limits. Thus, an active mutual fund should not own more than $200 million of a $2 billion firm. Given those limits, a $100 billion mutual fund would need to make the equivalent of 500 separate $200 million investments to fully invest its $100 billion fund. That does not sound like active selective investing, owning those 500 equal weight positions. Moreover, there are not 500 $2 billion firms in the United States. So a large mutual fund cannot effectively be an active investor in small caps. Our clients can. This is important as the 100-year track record for annualized stock returns is approximately 12% for small caps, 11% for mid caps, and 10% for large caps. Large caps have greatly exceeded 10% over recent years. They are overdue for a vacation. The shares of smaller firms are overdue for a material catch-up period. Many of those 10 largest firms benefited from global trade, a strong US dollar, and a virtual monopoly in growing niche industries. Global trade has been hit with tariffs, taxes. The US dollar has weakened, and the largest firms are now reaching for growth by entering each other's silos. Profitable businesses attract competition, which in turn slows their growth. As if that wasn't enough, as detailed in our last newsletter, many of these mega capitalization firms are using their growth capital to invest in unprofitable server farms. Server farms earned a bad reputation, so the industry renamed them AI data centers. Regardless, new data centers tend to be unprofitable. As more are built, competition increases, and they could become even more unprofitable. As the largest firms face increasing competition and invest their future growth capital into unprofitable ventures, their overall growth rates will decelerate. Importantly, this second derivative, the acceleration or deceleration of growth, can greatly affect stock valuation multiples. As the growth rates of many of these larger firms decelerate, their valuation multiples should contract, declining to more normal levels. Their stock prices should face material pressure, as will the stock market indices that they dominate. As these mega capitalization firms enter each other's spaces and increase competition, their consumers, including smaller businesses, will benefit from the resulting innovation at lower prices. Smaller firms benefiting from stronger domestic economic growth will generate stronger revenue and earnings growth. As various small firms' revenue and earnings growth accelerate, and the largest firms' growth rates slow, some money will be drawn from mega caps to smaller capitalization firms. Thus, accelerating domestic economic growth should result in a broadening of the market. The reallocation of portfolio weights could have a meaningful impact on smaller firm valuations. Expect the combination of long-term growth and valuation multiple expansion to generate strong compounding of results. The consumer, their health improves with a faster growing economy. Wages should rise faster than inflation, productivity surges, resulting in more items being produced. Record tax refunds are spent fast. That is what the US consumer does. After this money changes hands, it doesn't just sit around. It tends to change hands again and again. This is the velocity of money. At a slow velocity of 4 turns per year, a record $250 billion of refunds and lower taxes can result in $1 trillion of economic growth. Extra cash in the hands of the US consumer results in ACCO brands selling more computer and gaming accessories. The October 1st launch of ACCO's Switch 2 accessories should greatly benefit ACCO's fourth quarter earnings, which will be announced next Monday, March 9th. Tax refunds can also pay for appliances at Lowe's. Consider replacing your loud washer before April refunds are spent and wipe out that store's inventory. Of course, those purchases can be initially charged on a Visa or MasterCard. Another example of a stock helped by consumers doing better is a debt collection firm, PRA Group. This firm buys old receivables from other firms, such as past due credit card debt from JP Morgan Chase. These domestic operations will benefit from rising consumer discretionary income, record tax refunds, and lower tax withholding. Its international operations are not subject to tariffs and benefit from currency exchange rates, the declining US dollar. PRA Group's restructuring of operations adds to its rising profit margins and record cash generation. This earnings acceleration is not priced into the stock. Annual earnings projections are $3 a share near term and over $4 within years. At today's price, investors are paying less than 6 times PRA's current earnings run rate. Combine future earnings growth with a higher valuation multiples, and shareholders can make a lot of money. Another area benefiting from cash trends is gold. For centuries, this commodity has been renowned as a hedge against uncertainty, volatility, and future inflation. Currently, central banks are buying record amounts of gold. In many cases, they're doing this as a replacement for their maturing U.S. Treasury holdings. China is buying gold as a replacement for its maturing U.S. Treasuries. This lowers China's dependence on U.S. investments without boosting its own currency value. Japan is using gold to help defend its currency and maintain interest rates. The Netherlands is replacing U.S. Treasuries with gold as an act of defiance related to Greenland and tariffs. Poland is adding more gold to strengthen its national reserve and offset geopolitical uncertainty. Despite record central bank gold purchases, supply is limited. The gold industry has a hard time replacing depleted mines. After a potential gold mine site is discovered, there's a long startup period, which includes years of surveys, various permits, inspections, and government approvals. Physical access can be a challenge. Miners must build roads and provide utilities, irregardless of the swamps, frozen tundra, mountain formation, floods, 20 feet of snow, flu outbreak, conflicts, and tribal negotiations. Yes, local labor is often required. This remote labor must first get trained in construction and then mining. Numerous disappointments occur along the way. At many mining operations, the smelter complex is referred to as the kitchen. Regretfully, kitchen fires are not that rare. If someone says we had a kitchen fire, it's a nice way of saying our ore smeltering complex blew up. Maybe that site's smeltering of ore can resume after 6 to 9 months of rebuilding, inspections, permits, and additional tribal negotiations. Those local tribes are a reminder of another risk called the rule of law. Governance of laws and frequent rule changes can occur in many countries with heavy mining operations. Production growth is valuable in this environment. We own Agnico Eagle and Wisdom Gold for their long-term production growth, low-cost mines, and geographic locations. Agnico's operations mostly reside in Australia, Canada, and Finland, while Wisdom's mines are in Canada. Well, why are we buying gold miners instead of just buying gold? A rising gold price raises the value of the future reserves yet to be mined. And few mining costs rise with the gold price. So as the price of gold rises, profit margins expand. Our research uncovered the few low-cost producers with future volume growth. And attractive miners tend to be acquired at a premium by larger miners. In previous years, we had 2 small Canadian gold miners. Pretium Resources was purchased by Newcrest, which was then purchased by Newmont. Kirkland Lake Gold was merged into Agnico Eagle. Today, we still own Agnico Eagle, which just raised its dividend, and we own Wisdom Gold, a small Canadian gold miner. Agnico Eagle happens to own several mines virtually surrounding one of Wisdom's best mines. I have no doubt the Eagle wants that mine. Wisdom's last reported quarter was the third quarter of 2025. Versus the previous year's third quarter, Wisdom's gold production grew 12%, and its average realized price for gold sales was 40% higher per ounce. Combining those resulted in revenue growth of 57%. Costs didn't rise as fast, so earnings rose by more than 100%, and free cash flow generation surged over 150%. In recent years, this small company has paid off all of its debt and now has a growing cash pile of approximately $200 million US. Its quarterly production can be lumpy and seasonal. When snow melts, swamps and mud appears. However, we expect long-term production growth to continue. Wisdom reports its fourth quarter earnings next Thursday, March 12th. Today, gold moved down with stocks. Gold moved down all the way to $5,116 per ounce. This is about 45% higher than Wisdom's average selling price of gold in the third quarter. Thus, we expect strong results in the fourth quarter that's about to be announced, and for earnings through 2026 as well. We also have some new holdings and portfolios, undervalued cash cows with prospects for future growth. Town Square Media provides digital media and marketing solutions. It has over 26% cash flow yield, cash flow generation relative to its stock price. This supports the 11% dividend yield. It also supports the reinvestment into its own future growth, its debt pay down, and share buybacks. One part of this firm designs computer customer websites and manages customer databases. This reminds us of our former investment in Web.com. Another part of this company designs advertisement campaigns and purchases various ad space for customers, which reminds us of our former investment in Interpublic Group. Both Web.com and Interpublic Group were acquired by larger firms. Town Square Media's current market capitalization is only $127 million. Compare that to $3.9 trillion for Apple. It's less than 1/300th of 1% of Apple's stock market capitalization. Warren Buffett would often sell 1% of Apple over a week and not move its stock price. Today, that 1% of Apple is worth approximately $39 billion. So that 1% of Apple could buy all of Times Square Media 307 times. Imagine how high Times Square Media's stock price could jump if someone just tried to buy 5 or 10% of the firm. Remember that $100 billion mutual fund? If it took its maximum position of 9 or 10% in Times Square Media, that would equate to 1/100th of 1% of the mutual fund value. If Times Square Media then doubled in value, the fund's value would go up by 1/100th of 1%, virtually unmeasurable. Investors would not be rewarded. Times Square Media can be 2, 3, even 5% of some of our portfolio models. A 5% weighting in Times Square Media for our clients would benefit from Times Square doubling over time. A doubling of Times Square would add to that portfolio's performance by, it would add another 5 percentage points. That's quite meaningful. So large mutual funds have a very hard time effectively investing in small caps. Because we're smaller than a $100 billion mutual fund, we're able to do that. We have started buying this stock with the goal of full positions by November, when Times Square should report accelerating revenue and earnings growth in its third quarter. Some days we can buy hundreds of shares, on other days, thousands of shares. These shares then get allocated between accounts that have cash to invest. With hard work, diligence, and patience, our clients might own 19% of Times Square by November. Future clients, future accounts, and future deposits will then have to wait to buy this stock, as we will certainly avoid 20% ownership levels at which we would be considered insiders, and it would be an enormous regulatory headache. Each of our holdings has unique positives. Unlike the average listed firms, our holdings generate excess free cash flow. Moreover, we expect each of our holdings to generate long-term growth of this excess cash. Our companies must then decide what to do with all of this excess cash. Scott, what do you think? Is this a good problem to have?
I would think so, Tim. So Tim highlighted several of our stock holdings, and those were just a few examples of those companies generating excess cash and how they can reward shareholders in a variety of ways. It's important to note that today, 50% of CMC companies repurchase a material amount of their own shares, and more than 80% pay dividends. Just on this slide, in the last 8 months, the companies you see here have announced dividend increases, and many of them, as you'll see on this slide, continue to increase over consecutive years. You can see CME Group in the February column. CME Group just this last month in February announced their 16th consecutive annual increase. Molson Coors, the symbol is TAP, and they are just announced their 6th consecutive annual increase, and Prudential their 18th consecutive annual increase. And on this next slide, you can see announced share buyback activity by our companies in just the last 5 months. So investing in cash cows, as Tim has gone through, has been a core strategy and discipline of CMC for decades, since the firm was founded 62 years ago. And it's why it has been able to generate long-term compounding results. And with that said, we're going to start our Q&A, and we already have several questions, so I'm going to try to read through them. The first question we have is, Tim, Mark, what effect will the tariff ruling have on the market?
The tariff ruling is, the headline is Trump lost the tariff ruling, and it has to go back down to the trial court. The tariff ruling is more than one sentence. It's many, many pages long, and in all those pages, the Supreme Court justices list the many laws they think Trump should have used to put the tariffs into effect. They think he used the wrong laws. So the saga will continue. It'll get played out over a long period of time, and there will be more appeals, and there will be changes in how the administration labels its current and future tariffs. So we have not seen the last of Trump's tariffs. And I think the market is gotten somewhat used to this. When they were first announced last April, there was great volatility, and the market has slowly recovered, even though there's continuing change in tariffs on a country-by-country basis. But some countries have negotiated treaties and better agreements, and so some of this volatility has actually gone away.
Okay, thanks, Tim. We got another question here. Where the toolbox on our screen is not showing the whole question, so I'm gonna do my best here. With the current fire sale in the market due to the Middle East conflict, how is CMC positioning increasing client investments in securities where available to take, I guess, again, I might be paraphrasing, to take advantage of a bargain basement while it still exists, if it does exist, or is the situation too risky right now? Tim, Mark?
Yeah, so if clients have cash available, obviously today, this morning is a good time to put some of that to work in companies that we believe are, future cash cows or current cash cows at very attractive prices. So I will say this most recent volatility has been short-lived. As far as yesterday, the market was, futures were down over 500 points, and the market closed basically flat. I think the S&P was up a little bit, and the Dow was basically flat. And then we had an 1,100 point decline this morning in the Dow, and when I walked in here, it was down in the neighborhood of 650 points. So it was a 500 point move in round numbers up. So we'll see how the day closes. But yeah, we're always looking to take advantage of dislocations in price and invest where clients may have some cash, or some stocks may do better in times of volatility, and you can trim those and get some that are at cheap prices.
We have 5-year price targets on all of our stocks, and we can sort the stocks on a daily basis by their anticipated annualized return over the 5-year period. And what happens in volatile periods is we can take an average holding or a holding that's moved up, and the expected return now is less, and we can trim or sell that and add to a holding that has a much higher expected rate of return, either because the fundamentals are accelerating, improving, or the stock was unfairly hit. So that is being done. You can see that in non-taxable accounts like IRAs, where we can move fast. We can move entire positions without worrying about taxes. In taxable accounts, we will look at every tax lot and the tax effect it would have on clients, long-term or short-term capital gains, and the magnitude of those gains. And so those moves might be a little bit slower. Some clients don't like paying taxes.
We have another question here. How is AI disruption affecting CMC's holdings?
Yeah, so in January and February, it was really interesting that AI disruption garnered a lot of attention. There was a report that was essentially a science fiction report written in 2028, and it was, these industries have been decimated because AI has taken all the businesses. There's no more white-collar workers, so the white-collar workforce can't spend any money, so that impacts all these different areas really badly. So it's important to, if you saw that or heard about it, it's important to remember that is just essentially fiction writing. There's no analysis. It's just kind of fun what could happen. So AI has hurt the software industry greatly, because people think that companies will be able to use AI to write their own software, and the SaaS or software as a service industry will be greatly impacted. Prior to this period, we didn't really have any stocks in that area, We did add FactSet, which was on one of the slides, because we thought it was unfairly hit. The stock had been hammered over the last 6 to 9 months and was at its cheapest valuation it had been. So we took advantage of that. MasterCard and Visa were also hit, as people thought that AI agents would start purchasing things for people, and they would do so with not using traditional bank accounts and credit cards and money, but do it using coins and things like that outside of the financial system. I think that idea is well off into the future. I don't think it's something that is at risk in the next 3 to 5 years. But we are keeping our eye on it. It's obviously impossible to predict how AI will ultimately impact the world. The Financial Times had an article that it could mean a utopia where we solve all shortages and everyone lives happily, and it could lead to the end of humanity. So that's kind of the positive and negative, and the most likely is something in the middle where it adds or takes away a certain percentage of economic growth for a short period of time. So
Previous technology cycles have been disruptive in different ways, and initially they benefit the producers of those technology. So in recent cycles, the chip makers, the software writers, those are the initial beneficiaries. Then the average company benefits because they learn how to use this new technology and increase their production, lower their costs, and benefit from the technology. And so the big wave of benefits accrues to the average company. And so we've already seen the heavy tech companies get their bounce from this wave of technology. Now, as average companies learn how to use this technology and see how they can benefit from it, we'll see higher production, greater output, and lower costs, which should mean higher profits from the average company. And this should benefit those shares.
Thanks, Tim. Thanks, Mark. I believe that's all the questions we have. Again, we're having a little bit of a challenge with the toolbar and questions. So if we missed your questions, we apologize. Feel free to email Tim or Mark or myself, and we will certainly answer your questions. As I mentioned at the beginning of this call, we are recording this. We will put it up on the website. You will get an email alert letting you know when it is up there. And once again, I want to thank everyone for attending the webinar, and we hope you have a great rest of the week. Take care.